All right, there are private equity groups that want a part of your 401k. So we are going to break down what is private equity, how can you invest in private equity, why do they want access to your 401k plan, and implications for both private equity, you, and the public stock market. So let's hop into it. So article just came out. Private equity wants a piece of your 401k and hopes Trump can make it happen. So what is private equity? Essentially, private equity is just, they are often in funds or in plans where you can invest into a private equity fund, and then they take that money and they go and invest or finance privately held companies. So private equity. Now, this is different from public because public, you can actually go and buy a portion of their stock on the market. It is publicly traded and it is open for people to go and buy stock. Private equity is a little more exclusive. A lot of times these private equity funds will say, hey, you have to be an accredited investor. That means that you have income thresholds or net worth thresholds to be able to invest in these private equity groups. So that is what a private equity group is in a nutshell. Just a fund that goes and they'll either buy a company, buy a portion of it, invest in it, or even can do some debt financing for these privately held companies. And they go and they try and just make money on the private market. So I was actually a controller. A controller is like a fancy word for an accountant. I was a controller for a company and we ended up selling to a private equity group. And so I have personal experience with them. They came in, they bought a good chunk of the company. They did not buy all of it, but they bought a controlling interest in the company. And oftentimes what these private equity groups will do is they'll come in, they'll infuse a bunch of capital. So they'll put a bunch of money into the business and then they try and grow it as quickly as they can. And then they go and flip it. So they go sell it, and that's where they make their money. They make their money off of selling it for higher than what they bought it for, which is completely makes sense. And the ways that they do this is they'll bring in a bunch of capital and then they add a management team to go in and just blow the company up, right? So they are often very well connected people. They have great networks and they know really smart people, and they can come in, put in different management strategies. They'll come in and try and grow. They'll hire a sales team. They'll hire a new CEO or a CFO that's really good at what they do. And they will go and try and just grow these companies as quickly as possible and then eventually sell it and bank off the profits. Now, private equity groups make their money by charging a fee for the money that people have invested with them. So for example, if you just said, hey, I'm going to invest $10 million into a private equity fund, then they'll say, okay, as a management fee, we are going to take 2% of that $10 million every single year as a management fee. Now, obviously, they want to grow their investments exponentially more than 2%. That way you're saying, okay, yeah, that 2% fee is totally worth it because I'm getting, a 12% return or a 10% return, then my 2% fee is worth it. Now, a lot of times these private equity groups can have even larger returns than that because they are a little bit more high risk. They do a lot of due diligence when they go in to buy a company, so they're making sure that it is something that they see huge growth potential in. And so a lot of times they are higher risk, which higher risk oftentimes will bring higher rewards, but there is obviously risks with that. I'm sure there are times that it flops. So they charge like a management fee a lot of times, and then they can also charge a percentage of profits. So if they come in and say, hey, we're going to buy this company with all these funds that these investors gave us, we're going to buy that company. 5 years later, we're going to flip it. And, say we had a big return off of it, we're going to take, 20% of that return. And that goes into that private equity group, that fund, and the people that manage it. They get that money. And then the rest of the return goes to the investors. All right, so how can you invest in private equity groups right now? Typically, you need to be an accredited investor. So I'm going to go over here to the SEC. This is a breakdown of what an accredited investor is. So it's individuals who qualify based on income thresholds. So you're going to have a net worth of over $1 million, excluding your primary residence, or you have income over $200,000 individually or $300,000 in each of the past prior 2 years, and reasonably we expect the same in the current year. So you have to have like really high net worth. A lot of these private equity groups, will actually have minimums on how much you can invest. Like you can't just go to them and be like, hey, I want to invest $10,000. At that point, they're just gonna be like, you're not worth bringing in and having to keep you updated and all of those things, all of the work that goes behind that for just $10,000. So a lot of times they are going to have very high minimums. Right here, I mean, this is on Investopedia. The minimum investment in private equity funds is typically 25 million. So obviously you have to have an insane amount of net worth. But sometimes they can be low as 250,000. I think that is a huge broad spectrum. I would expect you're going to have to bring at least a couple $100,000 to invest in most well-established private equity funds, and possibly even to the millions. So you have to be an accredited investor. So really that kind of cuts out a lot of America. A lot of just citizens cannot go and invest in private equity very easily because they just don't have the net worth. And I think the reason the SEC does this, puts these income thresholds on here, is they just don't want people who don't know what they're doing to go and invest and get screwed out of all of their money. They just don't want people, hey, you don't have $1 million in net worth, so we don't want you to go into these riskier investments. That's what they're doing that for. But I think that's kind of crazy because the federal government is also okay with Social Security and just forcing you to invest with a government-ran entity that honestly doesn't get that great of a return. Social Security is a little bit of a double standard in my opinion. What do you guys think though? Hit me up in the comment section. And if you're finding value so far, please give this video a thumbs up. So why do private equity groups want access to your 401k? Now this is crazy. So I just Googled this. As of the third quarter of 2024, there is almost $9 trillion held in 401k plans, and that's part of $12.5 trillion in employer-based retirement plans. So there is a huge amount of capital just sitting in these retirement plans, and that's why private equity wants access to it. So private equity, obviously they make their money by getting money, investing in different companies or financing them, and then selling them or collecting interest on the debt. That's how they make their money. So if they want to make more money, they need to bring in more money from investors and then go out and buy or finance more companies. So this is a giant capital pot just sitting there waiting for them, right? So if you have $12.5 trillion in employer-based retirement plans and you could access even just a portion of that, even if you could only access 10% of that, that's $1.2 trillion that they could go out and invest in companies to go and make more money. So I get why they want access to it. I mean, that is a giant chunk of change. That's why they want it. So obviously if they could take $1.2 trillion and charge a management fee on it and also get the profits from when they sell the company that they invest in, they can make a lot more money. So what are the implications? The implications on investing in private equity. I'm going to go over some of the pros that the average person could see from having the ability to go and invest in private equity. One is it just gives you more diversification. Right now, if you go and invest in a 401k, most likely you are in bonds and in stocks, and that's it. And the stocks are all publicly traded, right? So this gives you the ability to have some in bonds, some in publicly traded stocks, and some in privately held companies. So you would have more diversification, which sometimes can limit your risk. If the public market has a big drop. But honestly, if you had a big drop in the public market, you'd probably see a decent drop in the private market as well. But this allows you more diversification as far as your investments go. Another thing that I think is cool if this happens is it provides an exit for small business owners nearing retirement. So we have a lot of baby boomers that have built up these companies. If they've built up these good companies, private equity may come in and say, hey, this looks like a great opportunity for us to buy you to have a little bit of chunk of change to go and retire, and then we can sell this company later and make some money as a private equity group. So if there is all of a sudden a whole bunch of capital to go and buy these small to medium businesses by private equity groups, you could give a whole bunch of people, an exit plan. So that could be kind of cool. Obviously, to infuse capital into private companies, if we could throw $1 trillion into privately held companies and help them invest in their company and expand, then, we could get greater services. We could have some awesome technology come out of it. A lot of private equity groups go into the healthcare or the technology sector where they see high growth opportunities. So it could infuse a lot of companies with capital that they need to grow and expand and just, get better as a company. So those are some of the pros. Now, some of the cons is, it could hurt uneducated investors. So if all of a sudden you have this opportunity in your 401k to go and invest in a private equity group, if you do not understand private equity groups and you're just going in and just randomly selecting stuff and without doing your homework, you may end up getting, hurt in the long run because maybe the group that you invest in just doesn't do well. They're not doing the due diligence that they need when they're buying companies. And so it could hurt you. And that's one of the biggest reasons that this hasn't happened so far. Right here, the Biden administration has not warmed to the idea, but industry watchers expect that to change under Donald Trump's second term. So Trump's a little more pro-business. The argument against opening retirement savings to private equity is that funds can be riskier than plain vanilla index funds and are less liquid, making it difficult to get money out if things go sideways. So that is one of the big cons, is higher risk and less liquid, right? Because if you put all this money into a private equity group and they go and invest it in a company and they're going to hold it for 5 years, well, if you don't like that investment after 2, it's going to be tougher to sell it. It's going to be not as liquid. So that's one of the downfalls. Another downfall is it just may not be open to all investors. So if this change happened and they still required you to be an accredited investor, it just may not even be open to you at that point. Even if you have, $100,000 in your 401k or $200,000 in your 401k, but they still want you to have $1 million net worth before you can invest in private equity groups. All of this change may happen. It may not even include you. So that could be a downfall. One thing that I think would be interesting, though, is if we have $12.5 trillion in 401k or employer-based retirement plans, and private equity got access to that, and then people started selling off their public stocks to go and invest in private equity groups, it would be interesting to see how big of an impact that would have on public companies. Because if you have even just like a 10% sell-off, obviously when you sell, the price of things are going to just start dropping. It's when you have high demand and people are buying that prices increase. So if you have people selling off stocks, then stocks may drop even at a bigger pace than just the sell-off. So it could have a big impact on the public market and the public stock market. It could just see a drop. But what do you guys think? If you have any comments, hit me up in the comment section. Another con that I see is simply that it's just untested. It would be interesting to see the implications that it would have. How big of a jump would we see in small businesses? How big of a drop could we see in the public stock market? It's just untested. So that can be a con, but that can also be a pro depending on how things go. It'd be super interesting to see if this actually happened and private equity groups did get access to your 401k, allow you to invest in private equity groups. I was curious on this because as an investor, obviously, I want good average returns. And so right now, I'm just invested in index funds in the S&P 500, which, the S&P 500, the average annual return is around 10%, 10 to 12% over 30 years. So I looked, I'm like, hey, what's the average return on private equity groups? And, AI is telling me private equity has historically outperformed public equity markets with average annual returns of around 10 to 13% over the last 25 years. So, public markets on the low end, it's at 10, but private equity group, even if at the high end, it's 13%. Now, obviously, if you do that over your lifetime, a 3% annual increase every single year greater than what you have been getting is going to compound and be worth a lot more over 30 years. And so, having the opportunity to invest in private equity is intriguing to me. I think it'd be really cool to do. If you guys have any questions on this, please hit me up in the comments section, and we'll talk to you guys next time.